All right, folks, part 3. We're going to take a look at fictitious revenues. By the way, take a look at what they say here. FASB, that's the U.S., and IASB, that's the folks that do IFRS. They're working together. Like I told you, revenue recognition, this is the biggest issue for restatements. The other stuff there is interesting, but that's the important part there. So they're given a fictitious revenues example. So notice here, account receivable 350, credit 350, and then cash 350, 350. And then notice over here, fixed assets, debit, and cash. So I think what they're doing, they're basically showing where they're manipulating the numbers here. From what they show you, I can't really say. So they're increasing fixed assets, and they're increasing, I guess what they're really getting at is notice how all of the numbers are the same. It seems rather suspicious. You see this right here? This is the problem. Okay? So, by the way, sales with conditions, that's another one. So the sale is booked even though the terms have not been completed. By the way, so the risk of ownership is not passed to the purchaser. That's a requirement. Why? To boost company revenues. Okay? And again, it's not, doesn't qualify as recording as revenue until the conditions are satisfied. So again, improper recording. Folks are always looking to boost revenues, obviously, right? Sometimes loan requirements from banks, they have certain ratio requirements. The manager may be pushed to hit certain targets. Okay, so again, these are all kind of excuses. At the end of the day, you're not supposed to do this no matter what the pressure is. Okay. By the way, they talk about a lot of red flags. So, rapid or unusual profitability. Okay. Inability to generate cash flows from operations while reporting earnings. Like, how do you generate cash flows from operations, right? If you can't do that, you're not going to have earnings. Significant transactions with related parties or special purpose entities, SPEs. SPEs equal Enron. Famous for that, okay? Remember this, what I mentioned to you? Significant, unusual, or highly complex transactions. So what that means is, if you're looking at something, you're going, what the heck? Start looking more, okay? Unusual growth in number of days receivables. This is because they're fake. So all of a sudden your receivables go up. That's because they're not actual. Okay. All right. Timing differences, another, making sure recording in the proper periods. And by the way, here you're putting it in one period, so it's increasing or decreasing. It's going to increase one period, decrease the other. So, and then matching the revenues. Here, notice what they say. Record revenue in December and expense in January to overstate net income. The only problem is that only works one time. You know what I mean? And then you're gonna have a problem come January. But if you're looking at year-end numbers, this is why folks would do it. So here's the example. So they have, notice here, they have an account receivable and a sale from this project, $17,000. Okay. And this is for fiscal year, and then here they're showing 2009. This is in December 31st, right? And then look what happens in January. Now they're recording the cost. So December equal the revenue. January equal cost. Equals not gap. Big no-no. Okay. Again, revenue recognition, these are the items they're looking at. Like I mentioned, in intermediate, there's 5. I can't remember what it is. But anyway, the bottom line is they inflate net income in one period and then underreport in another. So it's kind of like you're constantly chasing it. Do you know what I mean? Now, So recognizing it in the wrong time, that's one thing. Fictitious is different. It doesn't really exist, but okay. So here's persuasive evidence. An arrangement does not exist. Okay. So you can look at these. There's nothing written verbal. A verbal agreement, but written is customary. Normally it's always written. By the way, big company, it's always written. Conditional upon sale. Anytime there's a condition. A right to return. As soon as there's a right to return, you have to wonder if you actually have a sale or not. A side letter alters the agreement, alters the terms. Related party. Okay. These are all warning signs. Now, delivery has not occurred or service has not been rendered. So there's all kinds of items here. You can read through these. Like here, bill and hold. This is a big one. Not all the components are done. Wrong items were shipped. I have personally seen this one. I actually had a company. You know what happened? I would place an order. You know what they would do? Even if they didn't have what I wanted. This, by the way, this was it was in a retail environment, but let's say you ordered black shirts. You ordered 100 dozen black shirts in certain sizes, and they didn't have it. They would ship you blue shirts, right? And then, so you open it up, and you get the blue shirts, and you're like, what the heck, right? And then what would happen when you call them up? They'd say, well, you know, they're normally $10 a piece. What if I give them to you for $7 a piece? So literally, that's another way to increase additional sales. You know, but I'm telling you, some of this stuff I've seen a lot. You can read through these items here. Okay. The price is not fixed or determinable. You cannot record the revenue if that's the case. Contingent on some future event. You haven't until the future happens. You don't have a sale. Unpredictable cancellation. Again, remember, we have to be able to reasonably predict the amount and the ability to collect. Option to exchange the products or others. Okay. So again, what this is, you know, kind of like the black and blue shirts there. Payment is extended for a substantial period. Okay. When that starts to happen, it starts to lead questions. Why is the company doing this? Okay. Collectability, not reasonably assured. That's what we were talking about before. Contingent upon some future event. Like, so for example, if the company buys from you, but they're only going to pay you if they sell it, right? That's a consignment. That's a consignment issue. That's not a sale. You didn't make a sale yet because your revenue depends upon them actually selling it. Okay. Long-term contracts. Now, again, this completed contract method, this is, you got to wait till it's 100% complete. Companies do that usually if it's within 1 year. And then percentage of completion. Again, notice here, it's vulnerable to manipulation. There's a lot of estimates here. I mean, you're looking at partially done stuff. There's different ways to do it, but anytime you're making that many estimates to get your number, there's a chance that it can be manipulated easily. Okay. Channel stuffing, we talked about this before. Overbuy, giving deep discounts. By the way, if there's good gross margins, they tend to do that. But again, it just steals from the next period. And then collectability of accounts receivable. If you oversell, can you collect? You know, you oversell the stuff, you give them great discounts, but at the end of the day, they have to be able to pay you in order to make the sale. Okay. Recording expenses in the wrong period. We just took a look at that just a minute ago. Not properly matching. Timing differences. Again, here is my favorite. A lot of folks do it. By the way, anytime it's near the end of a period, okay, here you go. Highly complex transactions. And anytime you see something unusual in a decline, either a decline, a growth, or a margin, always take a look. That 99% of the time, like, unfortunately, companies don't turn on a dime. When that happens, something is up. All right, folks, that's part 3. Got part 4 coming your way.